This note is about a single clause in a document strategy published a year ago. In July 2025, the company set out when it would not sell its own stock. Below 2.5 times mNAV, it said it would not issue common equity at all, with one exception, to pay interest on debt and to fund preferred dividends. That exception was written as the narrow case. 12 months later, the weekly filings show it running the entire capital structure. That is the finding, and everything that follows is the evidence for it. Start with 1 week, because 1 week contains the whole pattern. Between the 20th and the 26th of July, Strategy sold 5.4 million common shares, raising $544.5 million. It moved $525 million of that straight into its dollar reserve. It spent $25 million buying back its own preferred stock, the series paying 12% at a discount to face value, and it reported 0 repurchases of every other security and 0 preferred stock sales. Now the headline the company offers. The reserve reached $3.75 billion, covering roughly 25 months of preferred dividends and debt interest. That is real cash, and the arithmetic checks. But look at the balance sheet on the same date. At the end of June, the company held $1.71 billion of cash and $736 million of short-term investments, $2.45 billion in total. The policy reserve at that date was $2.4 billion. So the reserve is not a buffer sitting on top of the company's liquidity. It is, to a first approximation, the entire liquid balance sheet. That distinction is the note. Here is the mechanism in 3 parts. First, the exception. The 2025 framework divided the world into 3 bands of mNAV, the multiple of net asset value. Above 4 times, issue actively and buy Bitcoin. Between 2.5 and 4 times, issue opportunistically. Below 2.5 times, do not issue common equity at all. And then the carve-out, except to pay interest on debt obligations and to fund preferred equity dividends. Second, the engine. In the last disclosed week, the company issued $544.5 million of common stock, and $525 million of it went directly into the dividend reserve. That is not opportunistic accumulation. That is the carve-out operating at scale. Third, and this is the part a credit desk should sit with, the circularity. The reserve exists to insure against an interruption in funding. The reserve is filled by issuing equity, so the thing it insures against is the thing that fills it. Under stress, the coverage months are a countdown, not an independent buffer. One caution on the evidence: this note carries a single dated mNAV print for Strategy at 1.09 on the 2nd of July. No earlier print exists in this evidence base, so no week before that date is positioned against the bands here. The reserve bill tells the same story in a different register. 9 weeks. At the 25th of May, the reserve stood at $871 million and $900 million by month end, $1 billion by the 7th of June, $2.55 billion by the 28th, alongside the digital credit framework that gave the reserve a board-approved floor, $3.225 billion by the 19th of July, and $3.75 billion by the 26th, after another $525 million was added from that week's share sales. Roughly $2.9 billion accumulated in 9 weeks, and common stock issuance is the only large disclosed inflow lane. 2 details are worth pausing on. The 19th of July figure explicitly included expected proceeds from share sales that had not yet settled, so part of the insurance policy on that date was a receivable from the channel being insured, and over the same period reported cash fell, quarter after quarter, from $2.3 billion to $2.21 billion to $1.71 billion, even as the policy reserve rose. That is consistent with a reserve continuously refilled from issuance rather than accumulating from operations. The asset being accumulated in 2026 is not Bitcoin, it is dividend-paying capacity. Look at where the cash actually went this year, because the allocation says something the totals do not. In May, the company spent $1.38 billion of cash to retire $1.5 billion of principal on its convertible notes. Those notes carry a 0% coupon. Retiring them removed a maturity wall in 2029, but it saved no annual cash at all. In July, it spent $25 million retiring $28.9 million of the preferred layer that pays 12%, cutting about $3.5 million of annual dividends, a 13.9% cash-on-cash reduction in fixed charges. $55 went to the 0 coupon problem for every dollar sent to the 12% one. That allocation is coherent if the binding constraint is the maturity wall, rather than the annual carry. A desk should know which it is. Both readings deserve to be put at their strongest, so here they are. The supportive reading. The company has done exactly what it announced it would do. The reserve was established in December 2025 with about 21 months of coverage. It moved through the stated 2 to 3 year target zone. It now sits above 2.1 years. 18 consecutive months of preferred dividends have been paid, none missed, through a deep drawdown in the underlying asset. And when you check the company's coverage arithmetic against its own disclosures, it reproduces exactly. The arithmetic is internally honest, the structural reading. The coverage figure and the market access assumption are the same fact stated twice. Every one of those coverage figures is unsecured. The preferred stock is expressly not collateralized by the Bitcoin, the reserve is not ring-fenced, and the only same-date disclosure of pledged assets is from the 31st of March. Seniority, not security, is the protection, and the payment record is younger than it looks. $1.06 billion paid over 18 months averages about $59 million a month. The current run rate is about $147 million a month. The track record was earned at roughly 2.5 times lighter a load than the one carried today. Neither reading is disclosed as the rule. The evidence carries both. So what does a desk actually do differently on Monday morning? First, read the weekly filing as a funding flow statement, not as holdings news. 3 lines, proceeds from share sales, the change in the reserve, and repurchases by series. Flag any week where stated uses exceed disclosed proceeds. In the week of the 20th of July they did, by about $5.5 million, implying a small draw on other cash. Second, split every reserve figure into settled cash and unsettled proceeds, because at least one published figure mixed them. Then reconcile the policy reserve against reported cash and short-term investments every quarter. Third, do not roll the encumbrance anchor forward. The last same-date disclosure of pledged versus unpledged holdings is the 31st of March, and everything after it is gross holdings only. Fourth, and this is the single largest variable, watch one monthly rate decision. Stretch accounts for roughly 71% of the entire fixed charge base. Each percentage point of its dividend rate is about $105 million a year. Management intends to hold that rate elevated until the instrument trades near face value, so the costliest layer stays costly by choice and the whole live funding burden lands on the common stock channel. Fifth, keep 2 claims ledgers side by side, the issuer nets preferred at notional, the third-party framework at accrued liquidation preference, and the gap between them widens the moment a dividend is deferred. And sixth, map cross-holdings before you net exposure across treasury companies. One issuer holds $50 million of another's preferred as an asset. To close where we began, the company has not abandoned its rulebook. It is operating the clause of the rulebook that was drafted for the defensive case, and no disclosure reconciles that clause with the newer language adopted in June. What would change this view? A sustained return to disclosed Bitcoin purchases funded by issuance above the reserve floor, or the preferred series returning to face value, its shelf reopening, and its rate stepping down. Either would show the dependence on a single funding channel was transitional rather than structural. Both are observable in the same weekly filings this note is built on. This is research commentary, it is not investment advice, and it carries no recommendation.